Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE Pinviz powered by CNBC TV 18. This week we get our experts to meet the young employees of the magnificent Taj Palace in New Delhi.
I have invested in real estate and I have invested in stocks and well, insurance policy I used to do it earlier, but I think it's not investment because it doesn't give very good returns.
Maybe stocks I would like to invest in. I would like to go in, though I don't understand stocks as well, but a couple of my friends at workplace, at my family, they invest in stock. That's what I want to go and see how does it apply. But as of now, I don't have any knowledge about the stocks.
I would definitely like to invest in mutual funds. Not that I understand much of it, but then I understand there are low risk and medium risk and high risk mutual funds that one can invest into.
It would be nice to get a little input on risk assessment because there's a lot in the market to offer, but you're constantly reading those fine prints that say, so and so is subjected to market risks. It would be nice for someone like me to understand what is the impact of that, implication of that fine print.
I'm more interested in being able to understand how you go about balancing a portfolio. They say that there's supposed to be a balance and there's supposed to be some high risk, some high return kind of a portfolio.
We're now joined by our two experts. We have Harshvardhan Rungta, who's a certified financial planner at Rungta Securities. Welcome to the show, Harsh. And we have Gajendra Kothari, who's the MD and CEO at Etika Wealth Management. Welcome, Gajendra. Gajendra, first question to you. When people hear the word personal finance, they get very overwhelmed because it's such a huge subject. Is it possible for you to make it a little simple for the layman?
Okay. Yeah, as you rightly said, in India, we say almost 95% of the population is literate. But when it comes to financial literacy, very sorry to say that we're just 5% of the people who are financially literate. And this is very important to know because in our syllabus, in our course studies, in our education system, we don't have anything to do with personal finance. While we may study astronomy and whatnot, but as basic as how to manage money is not been taught. So that's why we are always overwhelmed by this question. But I can put down in 3 simple ways how you can actually make personal finance work for you. So you would have all heard of Warren Buffett, who is the world's richest investor. He has made his entire money by investing. Okay, so the same way in our case, and why? How could he make? Because he started at 11. He first bought his first investment at 11, and now he says that was too late actually. So in today's show, we see a lot of young minds out here. My first suggestion to out here is start right now, start early. And someone has said, well begun is half done, right? So if you can start early, you'll have a lot of time for your money to grow. And there's something called power of compounding. I don't know if you've ever heard the term. This is, Albert Einstein says power of compounding is the greatest mathematical discovery ever made. And if you start now, and if you just continue for next 20, 30 years, the kind of money you'll make is amazing, That will take care of for the next 20, 25 years in your retirement.
So, okay, Harsh, let's assume we've started early. But there's another thing which is really important is discipline and patience. How do you get people to follow that path? What's your experience?
We've heard long-term investments, right? We know people giving us statistics saying that over a period of time, equities is the best asset class to be in. So over 30 years, if you look at Nifty, ever since it has been launched, it has given up a 17% compounded returns till date. Now the idea is, have you stayed that long to take the benefits of equity? Now compare, we all know, we know that our ancestors are invested into real estate. Some of us are bearing the fruits of those investments today. So invariably, we've landed up holding that asset even till date. So we have, something invested, suppose ₹1 lakh was invested into a land by your great-grandfather. Today that sells for like about 20 crores. So we feel that real estate has given us good returns, which it may have. I am not denying that fact. But have you realized the underlying philosophy behind it? Your great-grandfather had invested and you are going to realize it today. So there is one question of discipline and patience. right? So while an asset may give very good returns, the investment has given good returns, but has the investor got those returns? So equity has done very well, but have you done very well in your equity investment? So there are two things that you need to keep in mind with any investment. You need to have patience. You need to maintain discipline.
Gajendra, the other point is also that not everybody, like a lot of people do equate equities with high risk. And it's always the thought, that I'll put my money in, mera paisa doob jayega, kya kare? What's your viewpoint on that? How do we counter this?
Okay, it's a very good.
Why should we look at equities then?
Okay, equities. It's a very good question, very valid question. The moment the word equity comes, we equate it with gambling or casino. Not for me. But actually, equity is the best way to create wealth. Now, when I say why, see, always remember, equity is risky in the short term, but it's very safe in the long term. Now, let me tell you how. So, suppose you all are employees of Taj Hotels, right? If I were to ask you a question that today or tomorrow, how much sale you will make, how many rooms will you occupy, you don't have an answer because it can change. But over a long term, if I ask you, how is the business model of Taj? And it's the best hotel in India, and the occupancy rate is very high, a lot of guests are coming. So it's a good sign. So in the long term, Taj will make great amount of money. So the same thing is with equity. In the short term, I don't know what are the trends, what policies come, how is the season right now, what factors can influence. But in the long term, if the company is doing well, you as a shareholder will always make money. And why I always say equity in the long term will give you high returns, because this is one of the asset class, one of the very rare asset class which can beat inflation in the long term.
Previously, as I've raised it for real estate, though it's in long-term investment, but as far as the risk factors are concerned, so if you can just highlight on some of the risk factors over here. It's a long-term, it's been based on the investment as well, the amount is huge, everything is okay, but what are the risk factors?
Real estate at first is an important asset class. Okay, you need to, or rather if you can afford to, you should invest into real estate. Now the bigger question is how much? Okay, if it's the first house that you're buying, then you have the liberty to ignore the rules of asset allocation and invest a major portion, or rather everything that you have, into that asset class, because that is what it will take for you to get a house for yourself. Now let me explain this. If you were to take this through a housing loan, the eligibility that a bank looks at while granting you a loan is basically 50% of your income. They assume you can give as EMI. So if you're earning 100 lakhs, if you're earning 1 lakh rupees, 50,000 the bank assumes is what you can give as EMI. How much would a loan come for an EMI equivalent of 50,000 rupees? In layman terms, it is about 50 lakh of rupees. So you will be granted a loan, sanctioned a loan up to 50 lakh of rupees. Now what happens in this case? If it's your first house, we excuse an investor and say you can go ahead and do it. This will suck out the entire liquidity that you have. 50% is your expenses, the other 50% has kind of gone into paying for only one asset class. So you have nothing left, theoretically, to invest into any other asset class.
What is good, VPF versus ELSS?
Okay. PPF versus
in terms
ELSS.
of return
A very
and
good
tax
question.
saving.
If you are an investor who wants absolute safety of your investment, PPF is the best choice. It will never give you sleepless nights, right? But hang on. If you are young and if you have 30 years to retirement, and as we mentioned, the inflation is like 10%, 11, 12, whatever, 8% may not be enough. So that is where government has given another option, which is tax-saving mutual funds. If you invest in those category of mutual funds, A, you get tax benefits, and secondly, as data suggests, for the last 20 years, these funds, on an average, has given 18-19% per annum return tax-free. Okay? Now, I'll give you a very live example of a case study of an investor who has invested for 16 years in a PPF. Altogether, in the last 16 years, he has invested 12 lakhs rupees per annum, and this is a real case study, by the way. Over a 16-year period, that 12 lakhs has today become 20 lakhs rupees in a PPF. If the same person would have invested the same amount on those days when he is deposited in the PPF into a tax-saving mutual fund, you know what is the value today? It's 81 lakhs rupees, tax-free. 20 versus 81. Obviously, in the long term, as I mentioned in my initial comment, equity is safe in the long term and equity can create wealth. So if you can take bit risk in the short term, because in the short term market will be volatile, but in the long term if you just stay invested, ELSs can be a far better option for you.
This is NSE FinViz powered by CNBC TV 18 Season 2. It's time for a very short break. Don't go anywhere. We'll be right back.